On behalf of EY, I would like to welcome our audience to the next edition of our on-demand audio series on the impact of the pandemic in financial services. In this edition, we will take a deeper dive into the challenges facing the housing finance and mortgage sector. To do this, I have a team of EY specialists joining me from our financial services organization. My name is Brian May. I'm the accounts managing partner for the financial services organization in the Americas. With me, I have Doug Kelly, a principal in our consulting business, Matt Stredbeck, an assurance partner and leader of our mortgage banking practice, and Dan Thane, also a principal in our consulting practice. So clearly there's been quite a bit of impact discussed on the overall banking market from this pandemic. Doug, maybe you can talk us through what has been less discussed, and that is the impact of this in the housing and mortgage market broadly.
Thanks, Brian. Let me start with a few broad comments about the overall housing market. First, today's discussion will be on residential housing and mortgage market, but the points are relevant across commercial real estate, multifamily, and including other real estate participants such as developers. I think it's important to state as we kick off the conversation just how critical housing is to the American economy. It is 20 to 30% of GDP in some form or fashion. So housing and the American economy are coupled and intertwined. The pandemic has resulted in disruption to the industry that is broad, deep, and impacts the entire value chain. All of this has happened at an exceptionally fast speed. This crisis started as a serious health matter and has now become a credit, market, and liquidity crisis. And the mortgage industry is ground zero for impacts. We are likely going to see longer-term impacts and changes to the business model along the entire value chain coming out of the crisis that will address many of the issues that we're going to highlight and unpack today.
Great. Given that purpose of housing, what are we seeing for borrowers and renters at this stage in the crisis?
To be blunt, Brian, the situation is not very good for either borrowers or renters. As of April 16th, we have 20 million plus initial unemployment claims filed. And we're starting to see these unemployment statistics run into forbearance requests, approaching 5% of outstanding loans for certain product types. And this is only going to be increasing over the coming weeks and months. April rent collections experienced high missed payments as well, exceeding 30%. The duration of the crisis and overall broad economic damage is going to translate into further stress on the housing market and key stakeholders, including borrowers and renters. On a positive note, the housing market was going into the crisis on stable footing, and there has been significant equity that has been built by homeowners over the past decade. However, there is potential for housing price declines depending on the depth and duration of the crisis, and there will likely be significant regional home price disparities based on how the virus propagates.
So we've unpacked quite a bit around the policy measures as it relates to small business owners and lenders in this series. So far, what are the policy measures that are out there to support borrowers in the housing system?
The programs and policies that have been rolled out over the past 2 months for supporting and stabilizing the American economy and by association the housing industry in both breadth and scale have few direct parallels in history. Let me touch on a few key points. I'm not going to unpack all the legislation and facilities that have been established because there's quite a few, but understanding the scope is important. So first, the Federal Reserve has executed rate cuts, asset purchases, and established lending facilities. The rate cuts will help from refinance volumes, stabilizing home prices, and supporting the overall economy. Asset purchases, particularly several $100 billion of MBS and CMBS, have helped support pricings and valuations. And the lending facilities, such as the primary dealer credit facility, is helpful to supporting the overall financial markets. Next, the CARES Act, a historic piece of legislation, both the size and scope of the bill. For housing, forbearance is the headline. Next, eviction and foreclosure suspension are also significant provisions in the bill. Other components that also support the companies and stakeholders around housing finance system will touch on CECL and troubled debt restructuring relief. And finally, state and local policy measures have also been taken. So state and localities have been very assertive with rolling out policies around foreclosure and eviction that have gone above and beyond timelines stated in the CARES Act. This is going to create multiple sets of regulations that are going to have to be monitored and implemented properly. As I reflect, untangling all of these programs and policies and how they relate to one another and how they impact the real estate and housing market is going to prove challenging. There will be many further policy clarifications and potential legislation coming. Monitoring this and implementing these changes and ensuring fair treatment of borrowers will be complex. This was an area of significant challenge during the financial crisis 10 years ago.
Yeah, that's great insight. So beyond the borrowers, how are the other participants in the housing finance market impacted?
Maybe starting with the lenders and originators. They've been tightening the credit box, increasing document standards, and we've seen a lot of loan pricing volatility for borrowers on the front end as well. So lenders are demanding higher credit quality borrowers. So, for example, a large lender recently announced a minimum 700 FICO score, 20% down requirements for new originations. Documents standards have been increased around additional employment verification required up to 10 days before closing. And then anyone who's tried to get a quote over the past 2 months have realized, just how volatile the prices are on the front end and how some of the market disruptions have moved into the originator space. From a spring market perspective, we see 20% decline in listings compared to earlier estimates, so overall slowing. However, we are very optimistic that refinance volumes are going to continue to be in record numbers driven by the extremely low rate environment. However, refinances may get more difficult if there's price disruptions and home price declines in the coming months. From an operational processing capability, we saw initial capabilities reduced. So offshore stress in locations such as India and the Philippines, but that has come back online over the past few weeks. Transition to working remote had some initial disruptions, but I think we could all declare a success story for most companies, and people are back online. Additionally, originators have been changing processes. So appraisals have gone virtual, title backlogs have been worked through. Many creative solutions have been put in place and are really making a difference as far as working through volumes and ensuring borrowers get loans in a timely manner. From a servicing perspective, 3 big issues I want to cover: advances, forbearance, and MSR valuations. For advances, the sheer magnitude required to create the liquidity and overall solvency stress and the dollars needed for the advances will be significantly higher than what was ever contemplated that servicers would have to fund. So what servicers are most impacted? Deposit fundings matter. So this will be banks versus non-banks, larger versus smaller institutions are really driving who has the liquidity risk. Ginnie Mae servicers are better off due to the pass-through assistance program, a real lifesaver from a liquidity perspective for funding those advances. And Freddie Mac and Fannie Mae have not announced liquidity plans for servicers. This was at FHFA's direction, which has really become a hot topic for the industry. Also, I think it's important to note that oversight of servicers are going to be increasing. So rating agencies as well as GSE oversight is going to be more assertive and more prescriptive, looking at financial and operational measures of performance in the real time. From forbearance volumes, huge increase in forbearance volumes have been experienced. What this means down the road for other loss mitigation strategies is still going to have to get worked through. And finally, MSR valuation declines have been dramatic. Issues around market depth, modeling assumptions related to loss mitigation, servicing cost have all impacted pricing. Next, moving to investors, credit is the big topic and associated liquidity with credit. So credit risk pricing, MBS spreads, and depth of the market have all been in focus. For example, the credit risk transfer program at the GSEs has essentially dried up. Credit has impacted certain market products areas more than others, as we've seen agency versus non-agency. In the valuation volatility that we've seen in March and April, significant spread differences in MBS been directly impacted by the REITs. I think it is important to note that the GSEs are stepping into the market to provide an overall counter-cyclical bid for loans. So this is where the GSEs are contemplating widening their credit box, stepping in, accepting that risk. And this is going to have an impact as far as continuing to provide the liquidity needed for loans from the originators. And finally, the mortgage industry is model driven. And what we're seeing is that the traditional models were not designed for a pandemic. So these models are going to require significant adjustments and assumptions through overlays. So there's going to be views as to, what's the trajectory of the virus, what geographies and MSAs are getting impacted, what occupations and industries matter, who goes back to work when. All these assumptions that go into the models will drive valuation reserves such as CECL, TDR, and overall pricing. In conclusion, Brian, there's 3 big points to take away. Borrowers and renters are financially challenged, and that's going to continue. Second, significant market stress around liquidity and valuation. And third, there's really been unprecedented legislation and policy that have been rolled out to address the virus.
Well, clearly a broad landscape there, Doug, and thank you for that overview. There are a couple of those points you've raised that I'd like to dive into a little deeper. Maybe I can ask Dan, to talk a little bit more about how the servicers are reacting to this overall disruption. So Dan, what are some of the challenges that the servicers are facing?
Thanks, Brian. Mortgage servicers are responding to multiple operational challenges as a result of the pandemic. In addition to responding to the pandemic itself and the impact on its customers and the individuals that make up its workforce, mortgage servicers are responding to the CARES Act and the broader government response. The CARES Act mandates a 60-day moratorium on all mortgage foreclosures and grants payment forbearance to borrowers who have a federally backed loan and have a hardship caused by the epidemic. The Act also provides credit protection to borrowers receiving the forbearance benefits. In addition, servicers are reacting to policy statements by various agencies such as FHFA and HUD and requirements from individual state governments. So far, more than 25 states have published guidance covering forbearance, foreclosure limitations, and credit relief. As a result of the epidemic and the policy changes, servicers have closed call centers and transitioned their workforce to virtual models. They've seen a spike in absences due to working parents staying home with children and seeing disruption with their third-party providers and global workforces. All of this while dealing with extraordinarily high call volumes. In parallel, servicers are unpacking the CARES Act and monitoring agency and state guidance to understand the impact to its policies and procedures and integrating these changes into its operations.
So how are they then reacting to that disruption?
We're hearing that our servicers are focused in responding in three ways. First, they're resolving the technology challenges associated with transitioning the workforce to a virtual model and adjusting their management routines to reflect those virtual models as well. Second, they're reassigning resources from other parts of the servicer's organization, or if it's a bank, from the larger bank organization to help with the increased call volumes. Thirdly, they're launching digital self-service options to allow borrowers to make forbearance requests digitally without having to call the call center.
So then what are they thinking about what's yet to come?
So far, the banks have been primarily concerned with the now, responding to some of the tactical issues that I just covered. As we look to what's next, servicers must consider what happens at the end of the initial forbearance period, where most servicers are offering 90 days. The CARES Act dictates an initial forbearance period of up to 180 days for federally backed loans, with a provision to extend for up to an additional 180 days. This next period could last from 90 days up to a year, depending on how the epidemic progresses and when the economy reopens. There are a number of actions servicers should be taking now to prepare. First, they'll need to make policy and process decisions on how to treat forbearance extensions for both investor-backed and portfolio loans. Will these extensions require just an attestation, or is there more dialogue with the borrower and potentially additional documentation required? Second, they'll need to enhance digital channels to deal with the additional complexity of self-service for the extension. Third, they'll need to ramp up their staff and train those new staff members to deal with the new call center volume. And fourth, they'll need to review their controls and their quality programs that are in place to make sure that they're treating borrowers consistently. As we look into the future to the beyond, there is less clarity on what is to come. Eventually, servicers will need to reinitiate collections and foreclosures. We anticipate regulatory scrutiny on how the relief was applied and the consistency of borrower treatment, similar to the financial crisis of 2008. The future isn't clear yet, but we do anticipate this event having a lasting impact on operating models, specifically with what can be done virtually.
And so what do you believe the biggest challenge will be in that beyond state?
From an operations perspective, the biggest challenge is likely yet to come as the borrowers start to exit the forbearance periods. Servicers will need to be prepared for the large volume of borrowers that will need to transition into loss mitigation activities, such as permanent loan modifications.
All right, Dan, thank you for that deep dive into servicers. And then maybe the last topic to cover would be liquidity and valuation in the market. And Matt, maybe you can walk us through what you're seeing in that space.
Thanks, Brian. Warren Buffett has a quote on liquidity I really like. He said, "Cash is to business as oxygen is to an individual. Never thought about when it's present, the only thing in mind when it's absent." Mortgage markets were volatile in March. Credit spreads on mortgage-backed securities widened significantly. This wasn't only on non-conforming products, but also on the ultra-safe agency insured securities, the ones backed by Fannie Mae, Freddie Mac, and Ginnie Mae. You can see on the chart on this slide that the difference between interest rates required on agency securities and those of U.S. Treasuries widened significantly as investors started to demand higher yields as the pandemic increased in intensity. Interest rates and security prices go in opposite directions. When yields go up, the value of securities go down. Mortgage REITs were the place that this was felt most acutely. REITs invest in securities to earn interest income for their investors. They pledge the securities with repo lenders. When the value of securities decline, the repo lender can demand additional cash be posted in the form of a margin call. The REITs were hit hard with margin calls, forcing many of them to sell securities at depressed prices just at the time they don't want to be selling in order to generate cash. Referencing back to my Warren Buffett quote on cash being king in a crisis, multiple publicly traded REITs announced that they were not able to meet their margin calls. Others announced they were slashing dividends to preserve cash. Thankfully, the Federal Reserve stepped in. Initially, the Fed pledged to buy $200 billion in agency securities. A week later, that hadn't stemmed the spread widening or the volatility. The Fed pledged to buy unlimited agency securities. Liquidity challenges also hit mortgage lenders and servicers, particularly the non-depository institutions. These non-bank mortgage companies don't have the luxury of stable customer deposits to fund their operations, but are often dependent on the capital markets for liquidity. The biggest remaining unaddressed liquidity issue in the mortgage market relates to servicers. Mortgage servicers collect principal and interest payments monthly from borrowers and then remit them to the agencies. The problem is servicers are required to remit the scheduled principal and interest, not the actual P&I they collected. This is good if you're an investor in agency securities, as you are going to keep getting paid every month, even if the borrower doesn't. Doug and Dan mentioned the CARE Act allows for mortgage borrowers in government loan products to request forbearance for up to 12 months. The speed of the downturn has been incredible. The Mortgage Bankers Association has reported borrower requests to delay mortgage payments rose 1,900% in the second half of March, as Americans suffered decreased wages and job losses as businesses and states shut down to mitigate the spread of the coronavirus. The MBA estimated that if 25% of borrowers avail themselves of the forbearance for up to 6 months, the liquidity strain on servicers could be $75 billion and could easily top $100 billion if longer. The chart on this slide shows different levels of potential required servicer advances. The Federal Reserve, in addition to restarting quantitative easing in March, also used its additional monetary tool of cutting interest rates, slashing the Fed funds rate to near zero. Mortgage servicers hold an intangible asset on their books called mortgage servicing rights, or MSRs. The value of MSRs are very sensitive to changes in interest rates. Decreases in interest rates decrease the value of MSRs as more customers are likely to prepay or refinance away their mortgage from the servicer. However, in the current environment, mortgage originators have been somewhat constrained to meet refinance demand due to work from home orders and other logistical challenges, like appraisers having the lack of ability to access homes. All of this has led to more of a mark-to-model versus mark-to-market environment, as there's been a complete lack of active trades recently for MSRs. We anticipate as part of the first quarter, MSRs will be down in value 15 to 35 basis points. Ginnie Mae has a program to help as a lender of last resort to fund servicer advances. The program does come with compliance and oversight requirements. As was noted, Fannie and Freddie have not announced any similar servicer funding facilities, and the director of FHFA has stated distressed servicers could be removed, leading to servicer consolidation. The MBA has requested that the Treasury Department and Federal Reserve create a servicer liquidity. It is yet to be seen if and when they would step in. Brian, our primary takeaways for the mortgage bankers in this environment is first and foremost, increase their liquidity posture and cash position. We know mortgage servicers that aren't waiting to see if the Fed will step in and are setting up advanced liquidity facilities at commercial banks. and are drawing down lines of credit to fortify their balance sheet. Second, it will be critical to have adequate support and documentation on the critical judgments made to fair value mortgage assets at a time of dislocation and wider price dispersion. Regulators and auditors will look for well-reasoned judgments on the challenging estimates that have to be made in an environment of uncertainty.
Well, that's great, Matt. And on behalf of our audience, I'd like to thank Doug and Dan and Matt for this insight in what is a very complicated and broad aspect of this pandemic in financial services. I think your insights today have been very valuable. And for our audience, I encourage you to stay connected to EY.com for future editions of this series and all of our thought leadership. And for any questions or feedback, please contact your EY relationship manager or any of our speakers today. Thank you, and as always, be safe.